Now, first and foremost, do you see this sell-off in the U.S. markets overnight, the ferocity of it actually, more than the fact that it came by, as a correction or the beginning of something more serious in terms of a reversal?
I think it's most likely a correction and is similar to the events that we saw late January, early February. So if you go back to the month of January, there was a big move in bond yields up to 2.8% in the U.S., which belatedly caused a correction both in emerging markets as well as in U.S. equities, including the tech space. In the month of September, we moved from 2.8 up to 3.2 on U.S. bond yields, and that move has belatedly caused a correction, particularly in tech stocks, which have higher valuations and therefore are more sensitive to discount rates. Beyond that, I don't see any particular strong fundamental reason for this move in markets. And I think after probably a relatively volatile month of October, U.S. markets will stabilize and probably begin to reassert their upward trend.
Okay. That's assuring to hear, Adrian. What about President Donald Trump's comments indicating to the market that, you know, the Fed may be running ahead of time when it comes to hiking interest rates and they might be pressing the pedal a bit too much? The underlying message there being that growth may not be looking as great as one had anticipated, which was the primary reason why U.S. equities, the dollar, as well as U.S. bonds or U.S. bond yields were rallying. How much of that is a question mark?
Yes, I'll maybe dodge specifically talking about President Trump's comments, but if we think about Powell's comments in the Fed and other members of the Fed, the U.S. economy is strong. Unemployment's at extremely low levels. We have a rising fiscal deficit with the tax cuts. And therefore, I think that the market has been talking a lot more about what neutral interest rates are in the U.S. and talking about numbers where the short-term interest rates would be above 3%. And therefore, you end up with sort of 3.2 on long rates. And I'd focus more on that. So at the moment, the economic data is still very supportive for capital markets. Then the question is, what is going to be happening this time next year in the United States economy? And you won't have the same fiscal impetus that you've had this year with the tax cuts. Plus, you will have had some effect of higher rates. And so, you know, I think there is part of this argument for why the market has corrected is, you know, concerns about growth later in 2019. And also what that means for earnings. But I think it's more a story of a deceleration as opposed to looking for a contraction in either economic activity or earnings.
Right. Adrian, you know, at a time like this, as an Indian investor, you wonder how much more are you going to fall besides the knee-jerk reaction that we're seeing today morning? Because we've already had it hard for us. We've already had both external as well as domestic factors. Do you sense that India then will be swept across if U.S. markets were to fall further? Or do you think the hit for us would be a little less because we've already fallen so much?
So I think you make a good point there, and this is a broad point for emerging markets. Because EM hit its peak in the third week of January, and since that period we have seen a repositioning out of EM equities, that the technical position in EM equities is more favorable than the correction in January this year. So you will see redemptions. But I don't think the magnitude of redemptions will be as extreme as we're seeing when positionings was very bullish as they were in late 2017.
So, Adrian, as an investor in India, what is it that you do when there are just so many, moving parts impacting where our equity markets are going to head? Do you buy this decline already, or do you think it's going to be foolish to try and catch a falling knife, or do you think that maybe it's time now to start buying, but in a staggered way?
I think that the driver of today's correction is the move in the United States, and that it's better for investors in risk assets to wait and see until they see some stability in the U.S. And once they see that, and there has been collateral damage in other capital markets, then they can take advantage of those more attractive prices. So you should wait until we see stability, and I think stability probably most importantly in NASDAQ. Remember, NASDAQ is still up about 8% year to date, even with the moves that we've seen in October, and that it's been the tech stocks that have been key to leading the U.S. rally.
Okay, Adrian, we'll chat again soon. Thanks so much for that quick reaction to what's going on in equity markets here back in India, falling in line with the rest of the globe. I just quickly want to revisit what the Nifty is up to. We've breached that 10,200 mark. I don't even want to go near what the market breadth is up to. Just to put it into perspective, I'm just looking at the F&O markets, and there are only 3 stocks which are standing to the advances. The rest all are in the red zone. It's only HPCL, ONGC, and to some degree a GAIL, which is just about surfacing in the green right now. Rest all stocks are in the red. The biggest losers, there's Bajaj Finance down 7.5%.